We're going to go to our panel here. I'm lucky to be joined by a former Bloomberger with me, Joe, RSM chief economist, and Stephanie Roth, Wolfe's research chief economist, to discuss this jobs report. Joe, I want to go to you first. What is the big thing sticking out to you here?
This is what a soft landing looks like. This is what full employment looks like. You should like full employment. I like full employment. We all should like full employment. This is just another and a steady drumbeat of very positive economic news.
If you're Fed Chair Jay Powell, Stephanie, and you're, dusting off your slippers this morning, pouring out your cup of coffee or whatever tea he might like to drink, what's your read on this at the end of the day?
He probably doesn't feel great about it. I hear you, full employment is good, but this isn't exactly the kind of print they were probably hoping for. I mean, especially the household survey, that was pretty hot. You saw over 700,000 gains in employed workers there. Granted, it's a volatile survey, but that took the unemployment rate down 0.2. So,
but does it take us so tremendously off trend that it's going to have the Fed kind of realigning or changing their tenor in these meetings right now?
Not necessarily, but I think the market took the Fed's, kind of ran with this narrative, and I think it's going to have to get reversed to some extent, at least after this print. Granted, the data are really volatile. This is a very seasonal month for payrolls, but it's just not exactly what the Fed was hoping for.
Fixed income market's a bit overbought. The appropriate fair value should be around 4.5% on the 10-year look. Once you lop off the 35,000 that we saw come back into the market, you got a much better number in terms of a Fed-centric view. They're not going to do anything next week. They're on hold. Now, we think there will be rate cuts, but in the second half of the year, primarily because we've got a maturity wall of debt coming due in 2025 and a huge tax cliff coming on the policy side. Best central banking policy is always forward-looking. Mm-hmm. I think by the time we get to the second half of next year, the Fed will be well-positioned to cut rates because we're going to be headed towards 2.5% on core and top-line inflation by the end of next year.
But if it's forward-looking, how do you continue to have the soft landing narrative when average hourly earnings are still a beat? We're seeing the market reacting to that. How do we get to 2% inflation with this strong of a labor market?
Because we can look at the Cleveland Fed's new tenant rent index, and we can see the dragging down of top-line inflation that's in front of us because of the easing in rents. Moreover, when you take a look at the trend in underlying wage growth, we're moving towards 3.5, which is what the Fed wants to see and what's stable. Look, one era ended. The era of zero interest rates is over. All of that data is very nice to talk about, but it's in the rear view mirror. And I think going forward, 3.5% on wages is what we should expect. Look, the economy is going to continue to expand. We think there's a 25% probability of a recession. 75% probability that we just continue to grow. Yes, things are going to slow. Hiring is going to slow. But it doesn't mean things are going to turn over. And I think one of the big takeaways about all of the data, slowing doesn't mean stalling.
Well, it's the Fed that cares a lot about this rear view mirror data, which is why we have to talk about it. Because, and as much as we've been trying to change their opinion of what they should be giving more weight to, whether you are Kathy Wood out there or anyone else who's saying, look at more forward-looking data here, or things that are actually continuously right in front of us here and playing out in front of our eyes. We got revisions in this report. We got more strength in some of these services producing sectors as well. What does it signal to you?
To me, it signals kind of very, very similar view in that the economy is not headed for a recession, certainly not in the first half of next year. I also think it's going to be hard for the Fed to be cutting interest rates in the first half of next year. I think it's going to be by Q3. Mm-hmm. At that point, the economy should be slowing sufficiently. Inflation should be heading back down to 2.5%. Totally echo the commentary around rent inflation coming down. It's very much baked in. By the time we approach the middle part of next year, core inflation should be at that 2.5% level, and then the Fed can feel comfortable cutting rates.
I got a first chance to look at the internals here. 3-month average annualized pace of average wage gains is 3.4%.
Yeah.
Right.
That's victory, people.
Right.
And also, by the way, this is the survey week was late in the month, which tends to boost the number. So we were actually looking for a number that was going to be a bit above expectations, purely for calendar effects. Last month it was quite weak at just about 0.2%. So if you sort of smooth out and look through a 3-month average, you're sitting at wage inflation that's not that far from the Fed's target.
We had 3.7% on the unemployment, or excuse me, 3.8% on the unemployment rate. We had 187 on the top line. So we liked the number not only because of the forecast, but because of the underlying trend, which is cooling in hiring, cooling in wages, which supports the other inflation data that we're seeing. Again, this is what a soft landing looks like. This
You're
is
beaming
good
right
news.
now. I can see it in your eyes.
All
You're
economists
thrilled.
should be. We all should be, because the Fed went from 0 to 550 basis points. In past economic cycles, that would have just kicked out the legs underneath the table and the economy would have crashed. It's not. Now, we still need to get a good handle on why that is. I'm not comfortable talking about immaculate disinflation, but it does look a lot like that.
Well, Fed swaps are pricing in less easing in 2024 following this report. So I'm curious, what does that mean for the dot plot? What are you anticipating next week, Stephanie, as we get that dot plot in?
Yeah, I think that the Fed's going to have to be looking for a couple of cuts for next year, but they're not going to be anywhere close to what the market's expecting. That's going to be difficult.
What do you think? 2, 3?
I think they'll probably be putting in for 3 cuts for next year. They're going to have to take up their GDP numbers. They'll take down their inflation numbers. So from that perspective, their numbers are going to look a little bit more soft landing-ish, and then they can be looking for about 3 cuts, but definitely not where the market is.
Starting in June?
Yeah,
Sorry.
2 cuts are already embedded. We expect 4. Moreover, you're going to see the 2024 median dot come down to 4.875. Market will move on that.
All right, we got to leave things there for right now. Stephanie Roth, Wolfe Research Chief Economist, joining us here on set, as well as Joe Brusuelas, RSM Chief Economist. Thank you both so much for helping us break down some of these jobs numbers here this morning.